Hello and welcome once again to the Smart Money, Dumb Money Show. And I am Keith Richards. I'm President and Chief Portfolio Manager of Value Trend Wealth Management, and I'm a technical analyst. Today's video is going to address the subject of if we are an index investor and we don't care about outperforming the market, we just don't want to be out of the market. So we might buy a broad index ETF of some sort. Well, should we buy the regular index, which is normally known as a capitalization-weighted index, which is where they weight the most predominantly traded stocks at that time as a heavier weight? The higher capitalized stocks are going to receive a bigger percentage of their influence in that index versus the stocks that have a much smaller presence on the market, the smaller capitalized stocks. So that is most indexes these days are capitalized weighted indexes. For example, the S&P 500 is supposedly around 500 stocks. Now, it's never exactly 500 stocks, but they call it the S&P 500 anyways. Be that as it may, the S&P has about 500 stocks, and yet there is usually a predominant sector that is driving the market, and therefore the capitalization of those companies tend to go up faster than the other companies and become larger in capitalization, in significance, you could say, in the index. So let's give the most recent example, and everybody is aware that the Magnificent Seven AI, artificial intelligence stocks, are outweighing all of the other stocks in the S&P 500. In fact, those 7 stocks represent about 30-odd% of the S&P 500. Now, isn't that crazy? 7 stocks represent almost a third of the whole index. That means that all those other stocks, the other 493 or close to it, are not doing nearly the amount of lifting and don't have nearly the amount of influence. All right. Well, that's great so long as those stocks are going up and you buy a regular S&P 500 ETF, you're going to do okay. But what happens when that sector changes? Well, what happens with a cap-weighted index is it's a little slower, but if there's a new kid on the block, let's pretend oil takes over as the next great thing and AI becomes far less important. So Nvidia and Microsoft and all them aren't as important and aren't doing as well, and their prices fall, so their capitalization falls. But suddenly Chevron and BP and all them become far more popular. I'm just making this up. They are going to now start influencing the index more than they did before, and maybe more than those 7 magnificent stocks. So that rotation is going to take some time, so it can cause a bit more volatility. Okay, so that is one of the things to keep in mind with a capitalized weighted index. However, that's the going game these days, isn't it? There is an alternative though, and that's called equal weighted index. You can watch the equal weighted indexes themselves, or you can actually watch the ETFs or buy the ETFs that are representing those equal weighted indexes. Let's use our example, the S&P 500. The S&P 500 is around 500 stocks, as we mentioned. In this case, rather than 7 stocks getting 30% of the capitalization or the share or the influence on that index, every one of those 500 stocks gets exactly 1/500th of the influence on the direction of the index. So you can imagine that can change things up quite a bit, especially in times when the market is raging on one particular group of stocks like it is right now. The question is, over the long run and over the short run, which is better? Which should we be investing in any time, whether it's a period of time when a group of 7 stocks are outperforming, or in a time when market's kind of fairly evenly distributed? Which is the best bet over the long run? So that's really the subject of today, which is better to buy a regular index ETF or or an equal weight ETF, if we are looking at buying an index to buy as a long-term investment. So let's take a look at the difference. And I've got some historical charts, which you might figure that I would have. All right, so I'm going to go right from the beginning. And from the beginning, there we go. Okay, case for sticking with equal weighted indices. See, I've just given away what my findings have come up with right at the beginning, but I want to bring you through why that is. So I have found that over the long run, equal weighted indices are the better way to go. There's a couple of reasons for this. So let's start right from the very near term though. So this chart is that of the S&P 500, the red line, and the equal weight index of the S&P 500. This is not an ETF, and these are the actual indexes. And this line down here shows us the comparative relative strength. If the line is going up, that means that the equal weight stocks index is doing better. If it's going down, that means it's doing worse. The equal weight is not the place to be. All right. Now, you might know that, so this chart only goes back to March of 2021. You might know that really since the beginning of 2023, that is when the AI stocks took off. It started with NVIDIA, which had bottomed at some ridiculously low price. And then suddenly everybody caught on to the idea that maybe this is a good idea, the artificial intelligence world. And so NVIDIA started moving, and that dragged any other company that even smelled like it had some AI influence in it, including the big players that actually are involved, such as Microsoft and Apple and Tesla and all of them. They made up those 7 stocks. And so what happened is that the influence of those 7 stocks took off in the index. And therefore, because they outperformed so much, the equal weight, which didn't have 30% of its stocks weighted in 7 of those 500 stocks, it had 1/500th per every one of those stocks. So it started to underperform. And you can see it underperformed from pretty much exactly when NVIDIA hit its bottom. And it started moving up, as well as dragging the other names along with it. And the rest is history. So it's literally been about an 11% difference between the 2 indexes since the beginning of 23. That is, the equal weight underperformed by about 11%. How's that for shocking? All right, let's move on. Here's almost a reverse of that. This goes back to 99. So it's not just a couple of years now. We're going back to 2099. Anybody remember 2099? That was the last tech bubble. It wasn't even the FANG bubble that led us into the COVID crash. This was the dot-com bubble, as they called it. And you can see the blue line is the cap weighted stock this time. Okay. And the black line is the equal weighted. All right. So the cap weighted is the traditional S&P 500 that we refer to when we say, what's the S&P 500 doing? And the black line is the equal weighted index of that. So what I want you to see here is that it's harder to see on the chart, but if we go here, we can see that the cap weighted started underperforming, meaning started outperforming. So when this line is going up, the cap weighted was outperforming the index, as we just mentioned, since the end of 2022. There's 11/22, and it was right around December or so. And then you see that it started moving up against the equal weighted. But look through history. Again, we're going back to 99. Okay, so we have like 24, 25 years of history here, and we can see that generally speaking, that wasn't the case through history. In fact, the equal weighted was generally speaking at least as good, if not a better place to be than the cap weighted. It's only been fairly recent, since really 22, that it's been overwhelmingly in favor of the capitalized weighted index. So that might be of interest to some of you, but wait, there's more. So let's take a look at a number of indexes. So I want to point out that this is a whole bunch of squiggly lines, but I want you to notice on the left side, they all start out at 100. Say $100 invested in every one of these indexes. in 1999. So it's the same time frame we just looked at, but it's looking at a whole bunch of other indexes. Okay. Now, again, I know I'm talking to generally some people watching this video who are pretty familiar with the market. So you guys know that the NASDAQ is the tech-orientated index, and because the tech stocks have been doing most of the lifting on the cap-weighted S&P 500, in other words, the normal S&P 500 index, then you also know that the NASDAQ has outperformed everything in town lately because it's got an even heavier weighting of tech and other such instruments in there. Okay, so I want to point out that the S&P 500, the normal cap weighted, is the blue line way down here. And then the NASDAQ is this kind of turquoise line, which is way down here. All right, so isn't that interesting? Right at the bottom. And then we also have the Dow, which is kind of a not so tech orientated. It's got Microsoft in it, didn't always, but it's a less technology orientated index that a lot of people follow. And as we go up the line, you see that has over the longer run outperformed the cap weighted S&P and the NASDAQ. And we go up the line here, we have the Russell 2000, which is the small cap. Sometimes they call them the value stocks, but it's been the small cap. Now, only recently has the small caps been the dog's breakfast. As you can see, the orange line underperformed, but over time, it was one of the better players. Now, there, right here, the black line here is the equal weighted S&P. So it's like, oops, I got to go back. Pardon me. I have to go previous, and I have to go previous again. So what we see here is the black line is the S&P 500 equal weighted. And even though recently the blue line, you can see the angle of ascent versus the angle of ascent since, say, 2022 was not as great on the equal weighted. There's the equal weighted. It really did nothing for most of 22 and then moved up in 23, whereas the blue line here started moving up aggressively from 22 and on. Okay. Still, at the end of the day, the black line, the equal weighted, outperformed the blue line, which is the cap weighted, over this 20-odd year period. Okay. And then finally, on the very top, we have the mid caps, the S&P 400, and it also outperformed. In fact, it even outperformed the large cap S&P index over the long run. Again, taking a closer look, though, you'd see from 22, it didn't do as well as this blue line, which basically shot straight up, as did the NASDAQ. Okay, so what I'm trying to show you here is that the longer term look for these indexes, the normal cap weighted S&P and the NASDAQ didn't actually do as well as the equal weighted indexes, let alone some of the other indexes out there. And the NASDAQ, it's really only found a voice in recent years. It was pretty much the dead last stock index since the tech crash in 2000 or so. All right. So I just thought you'd be interested in seeing that because it might change your mind on the long run of the equal weighted versus S&P 500 regular cap weighted index. Other thing I want to point out, going back to relatively recent history here, and that is that recently we have seen more volatility on the regular cap weighted S&P 500, which is this black line, versus the equal weight, which is this red and black line. Okay, so when we look at these two indexes, just from eyeballing it, I'm sure you can see this for yourself, and that is that the black line, the regular cap weighted, fell quite aggressively during 22. Everybody remember 2022? The market fell, all right, and it was overbought, and then it had a nice correction, a very healthy correction. Well, the S&P 500 fell quite a bit. Take a look at what happened during the same period on the equal weighted. It had volatility, but it kept returning to a neckline versus making a downtrend. Isn't that interesting? It was only after that period, again, going into that sort of 22 and on, that the black line, the regular capitalized S&P 500 started outperforming. Now, recently, you guys have maybe noticed, because you're watching this in mid-August, you will recall that early August, the market fell. Okay, so there you can see that on the S&P 500. Look at the cap weighted. It did fall, but it didn't fall as much. So something to keep in mind, when you are in an index that is heavily weighted in one sector or a group of stocks, then you are definitely trading off volatility. No doubt about it. It's like a diversified portfolio versus a very concentrated portfolio. If you're right, you're right. If you're wrong, you're wrong. And just keep that in mind when you buy a cap weighted index. So we've seen some evidence that over the long run, going back to 1999 actually, it was a better bet to buy the equal weight. And we're seeing current evidence that maybe the equal weight at least has less volatility. It may not be outperforming at this juncture, but it's certainly showing signs that as we've gone through some volatility over the past couple of years, it's showing signs that it has far less volatility, meaning you sleep better. And if history repeats itself and goes back to favoring equal weighted indices rather than the heavy weighted capital indices like the S&P 500, things might go back to their historic norm of cap weighted underperforming. All right, so I'll leave you with a couple other thoughts, and that is that no matter which index you take, this is the regular cap weighted S&P. We're in an uptrend and have been since 2009. That was that chart we drew a few minutes ago with all the indexes on it. And you can see that here's the recent correction, which is almost a joke. We may have some more room to go down. I'm not making a prediction, but over the past, even 15 years, we've seen lots and lots of volatility that suggest that markets may return to the trend line. Okay, one last thing, and that is I'd like to just draw some basic conclusions from our observations today, and that is that if the market continues to act like it has since 22, then you got to buy the cap weighted, the regular S&P. If the market continues to act like it has since 1999, 24 years ago, 25 years ago, whatever, the equal weighted S&P wins. Do you see? So no matter which the case, as we just saw on the 15-year chart, the one that went back to 2009, then the market's going up, whether you like the cap weighted or the non-cap weighted. It's just that you may take on more volatility, and you may, if things return to their historic norms, underperform a bit by owning the cap weight. That's not a prediction, that's just a history for you. So no matter what the case though, the market's in an uptrend right now, and you'll probably make money in both. So food for thought. I hope that maybe put a little bit of conversation in your brain, and you may decide to swing one way or the other. If you do decide to buy an index as part of your portfolio, if you do decide to buy the S&P 500 index, this is food for thought. I hope this helped. I thought it was an interesting study, and we'll be back next week with hopefully some more interesting stuff. Talk to you then.